Let me ask you a question that might feel a little uncomfortable. You've been working hard abroad, Dubai, Singapore, London, the Bay Area. You've been diligent. You send money home to India regularly. But what if I told you that for the last 10 years, your safe Indian investments have actually been losing money? I'm not talking about a market crash. I'm talking about something much quieter. I call it the NRI invisible tax. It's the combination of three things: inflation, rupee depreciation, and the massive regulatory changes that just hit us in July 2024. If you are an NRI holding over $1 million in liquid assets, the old playbook, fixed deposits and buying flats in your hometown, isn't just outdated. It's dangerous. I'm Kunal, representing EPK Capital. We specialize in building wealth for generations. And today, I'm going to share a strategy we use for our ultra-high net worth clients. We call it the set it and forget it plan. No tenant headaches, no FEMA penalties, just pure, compounding, repatriable wealth. Let's dive in. First, we need to address the elephant in the room: real estate. For decades, the NRI dream was to buy a property in India. It felt tangible. It felt safe. But the July 2024 budget changed the math fundamentally. You might have heard that the long-term capital gains tax on property was lowered to 12.5%. Sounds good, right? Here is the fine print that most people missed. The government removed the indexation benefit, that magic tool that allowed you to adjust your purchase price for inflation. Now, for resident Indians, there was an outcry, and the government gave them a choice: pay 12.5% without indexation or 20% with indexation. But guess what? You, the NRI, do not get that choice. That's right. If you bought a property 10 years ago, your inflation-adjusted cost is gone. You pay tax on the nominal profit. When you combine this with a rental yield of barely 2 to 3% and the hassle of property management from 5,000 miles away, real estate suddenly looks less like an asset and more like a liability. So, where should the money go? You want India's growth, but you want the dollar's stability. You want returns, but you don't want to check your phone every night. At EPK Capital, we construct what we call the Teen Fund Sovereign Portfolio. It's simple, it's liquid, and it's legally bulletproof. Half your portfolio goes into the India growth engine. We strictly recommend passive index funds like the Nifty 50 or Nifty 500. Why? Because over a 10-year period, 70% of active fund managers fail to beat the index. Why pay high fees for lower performance? You are betting on India INC, Reliance, HDFC, TCS. If India grows to a $5 trillion economy, this bucket makes you wealthy. And the tax? Just 12.5% on gains after 1 year. This is where most NRIs mess up. They have 100% of their India portfolio in rupees. But you live in a dollar or euro world. If the rupee falls by 3%, which it historically does, your portfolio value drops in dollar terms. The solution? International mutual funds. These are Indian funds that invest in the SP 500 or Nasdaq. Here's the massive 2024 update win. Previously, these were taxed at your slab rate up to 39% or 42%. But post-July 2024, if you hold them for more than 24 months, the tax is largely reduced to 12.5%. This is a huge arbitrage opportunity. You get dollar exposure managed from India with a tax rate that might be lower than what you'd pay in the US or UK. Finally, the sleep well bucket. Instead of fixed deposits, which are taxed at your slab rates and hard to break, we use target maturity debt funds. These buy government bonds. They are liquid. You can sell them tomorrow if you have an emergency. And unlike FDs, you don't pay tax every year on the interest. You only pay when you sell. That tax deferral allows your money to compound uninterrupted for years. Now, I know what you are thinking. But if I invest in India, is my money stuck? Can I get it back to New York or London? This is the repatriation myth. If you invest using your NRI account, the money is fully repatriable. Principal plus profits. No questions asked. If you have legacy money, say inheritance or rent, in your NRO account, you can still move up to $8 million per financial year. That's roughly 84 million rupees. Unless you are moving massive institutional sums, liquidity is not an issue. The RBI actually wants this process to be smooth. But here is the one mistake that will get you in trouble: the savings account trap. If you have been an NRI for more than 182 days and you still hold a regular resident savings account, you are violating FEMA regulations. The penalty can be up to 3 times the balance in the account. Please, do yourself a favor. Convert your accounts to NRO NRE immediately. It's a simple paperwork fix that saves you a regulatory nightmare. Investing shouldn't be exciting. It shouldn't keep you up at night. It should be like watching paint dry or grass grow. If you want excitement, go to a casino. If you want wealth, you build a system. The set it and forget it plan isn't about timing the market. It's about time in the market. It's about acknowledging that you are a global Indian who needs a portfolio that matches your global ambitions. At EPK Capital, we help families architect these portfolios every day. We ensure your KYC is compliant, your asset allocation is scientific, and your legacy is secure. If you are sitting on cash in FDs or stuck in low-yield real estate, let's have a conversation. We can review your current setup and show you exactly where the leaks are. I've left a link below. Click it and let's start building wealth for generations. I'm Kunal. Thanks for watching.